Deferred tax. It sits on nearly every set of financial statements, yet it remains one of the most misunderstood balances in practice. Accountants can mechanically churn out the number without really knowing what it represents or why it belongs on the balance sheet. In this episode, we fix that, grounding the whole topic in IAS 12 and building from the conceptual logic through to a worked example. Start with the why. Accounting profit and taxable profit are calculated under different rule sets. Accounting follows IFRS. Taxable profit follows the tax legislation of each jurisdiction. Those two sets of rules rarely agree on the timing of income and expense recognition. Deferred tax exists specifically to stop those timing mismatches from distorting the effective tax rate reported in profit or loss. Without it, the tax charge would spike or collapse from year to year in ways that bear no relationship to underlying performance. IAS 12 uses the balance sheet liability method. Forget the old income statement timing difference approach. That was superseded. Under the current method, you compare the carrying amount of every asset and liability in the financial statements with its tax base. The tax base of an asset is the amount that will be deductible for tax purposes in future periods, as the asset is recovered. The tax base of a liability is its carrying amount less any amount that will be deductible in future. Any difference between carrying amount and tax base is a temporary difference, and that is what drives the deferred tax balance. A taxable temporary difference arises when the carrying amount of an asset exceeds its tax base, meaning more taxable income will flow through in the future than accounting income. That creates a deferred tax liability. A deductible temporary difference is the mirror image. More tax deductions will come through in the future than accounting expenses, so you have a deferred tax asset. The classic taxable temporary difference is accelerated tax depreciation. The tax authority lets you write off plant faster than IFRS depreciation, so the tax base falls below the carrying amount quickly. Let's make this concrete with a worked example. Suppose an entity has a machine with a carrying amount of 900,000 Rand and a tax base of 500,000 Rand. The tax authority allowed accelerated allowances in earlier years. The temporary difference is 400,000. Applying a 28% corporate tax rate gives a deferred tax liability of 112,000. In the prior year, the deferred tax liability was 80,000. So the movement, the charge to profit or loss, is 32,000. Recognition of a deferred tax liability is essentially automatic. You recognize it for all taxable temporary differences unless a specific exemption applies. The two main exemptions are goodwill, where IAS 12 prohibits recognition because it would create a circular calculation, and the initial recognition exemption for assets or liabilities arising from transactions that are not business combinations, and that affect neither accounting profit nor taxable profit at the time of the transaction. Both exemptions are narrow and often misapplied, so tread carefully. Deferred tax assets require an additional hurdle. You can only recognize a DTA to the extent it is probable that future taxable profit will be available to utilize it. This is the judgment call that auditors focus on. For deductible temporary differences, the probability assessment is usually straightforward if the entity is consistently profitable. Unused tax losses are more sensitive. IAS 12 requires convincing evidence of future taxable profit, and the existence of recent losses is a strong indicator that recognition may not be appropriate without robust forecasts to support it. Measurement uses the tax rates expected to apply when the temporary difference reverses, not the current period rate. If new tax legislation has been substantively enacted by the reporting date, use that rate even if it is not yet effective. This matters every time a jurisdiction announces a rate change. In South Africa, a reduction in the corporate rate from 28 to 27% required entities to remeasure their entire deferred tax balance at the new rate, with the remeasurement running through profit or loss, not OCI. Where a deferred tax movement originates determines where you recognize it. If the underlying item went through profit or loss, the deferred tax charge or credit also goes through profit or loss. If the underlying item went through other comprehensive income, a revaluation surplus or a remeasurement of a defined benefit obligation, the related deferred tax follows it into OCI. This is often called the follow-through principle, and getting it wrong is a common exam and real-world error. Two areas in practice that generate the most complexity. First, IFRS 16 leases. Right-of-use assets and lease liabilities both generate temporary differences. A right-of-use asset typically has a nil tax base, creating a taxable temporary difference and therefore a DTL, while the lease liability has a nil tax base, creating a deductible temporary difference and a DTA. In many cases, these two offset, but the initial recognition exemption does not apply here. Because the transaction does affect both carrying amounts simultaneously, so you must recognize both. Second, business combinations under IFRS 3. Fair value uplifts on identifiable assets create taxable temporary differences, and you must recognize the DTL even though it increases goodwill. Conversely, you assess whether a DTA exists on the acquiree's unused losses at acquisition date. On the face of the statement of financial position, deferred tax assets and liabilities are presented as non-current. You may offset a DTA against a DTL only if you have a legally enforceable right to set off current tax assets against current tax liabilities, and the deferred taxes relate to the same tax authority and the same taxable entity. Netting across different entities in a group, even where group tax consolidation exists, requires careful legal analysis. Disclosures under IAS 12 are extensive. The components of tax expense, a reconciliation of the effective tax rate, and a breakdown of temporary differences. Let us also anchor the OCI treatment with a quick number. Suppose an entity revalues land upward by 2 million rand with a tax base equal to original cost, implying a taxable temporary difference of 2 million. At 27%, that is a DTL of 540,000. The revaluation surplus in OCI is recorded net of tax, 1,460,000, with the DTL of 540,000 recognized directly in OCI, not touching profit or loss at all. To bring it all together, deferred tax is not an arbitrary plug. It is a principled mechanism to align the tax charge with the economics of the period. Master the balance sheet method, be disciplined about the probability test for assets, apply the follow-through principle for OCI items, and watch the rate you use when legislation changes. Get those 4 things right, and deferred tax becomes one of the more logical areas of IFRS rather than one of the most feared.